Hello, and welcome to the Consumer VC podcast, where we discuss the intersection of venture capital and consumer innovation. I'm your host, Mike Gelb, and if you're enjoying the show, you can subscribe to my newsletter where you'll receive every new episode a week early. Head to theconsumervc.com and click subscribe. All content and episodes are for informational and entertainment purposes only and is not investment advice. I want to thank Anna Whiteman for introducing me to our guest today, Sarah Foley. Sarah is a partner at SWAT Equity. SWAT Equity invests in high-growth consumer brands that are disrupting their categories with a differentiated product, service, or technology. Some of their investments include Supergoop, Banza, and Mad Rabbit. We discuss why invest in consumer today, the difference between consumer and tech from a portfolio and return standpoint, macro trends she's bullish and bearish on, and what are the signs a company is actually breaking through the noise. Without further ado, here's Sarah. Sarah, thank you so much for joining me here today. How are you?
I'm good. It's so good to see you, Mike. I'm so glad to do this. You have an amazing following. I'm honored to be on.
Let's start from the top. What was your initial attraction to investing, and why consumer? What about consumer brands made it appealing to you?
Why did the fickleness of consumer lead me to believe it would be a great investing category?
That's a much better way to phrase the question, indeed.
So I would answer that maybe a couple of ways. The first way is I'm just a business model voyeur by nature, which I guess I've honed over the course of my career, which has been longer than I care to admit, investing in companies. And not only in the early stages, kind of where I sit today at SWAT Equity, investing in early stage consumer brands, but really across the entire capital stack, if you will. Angel investing personally for long periods of time, even actually doing that in Broadway productions, which is a different version of venture capital. Wow. Through to the more traditional private equity leveraged buyout style of making investments. But it's always just been a huge curiosity and fascination to understand how companies make money. And what I love about consumer is just the tangibility of it. You know, we get to talk about the products and even the services that one can go experience, the experiences themselves around consuming brands, which is a lot easier for me to talk about than how this particular enterprise level software solution is utilized by a big corporate Fortune 500 company.
Yeah, I was talking to a guy who'd built a incredible consumer brand, and he actually came from the software side originally and was an early employee at a pretty big software company now. And he was saying how building a consumer, though, like even just going to a dinner party or something, it's so much more interesting and fun talking about building a consumer brand than it is like talk about like enterprise SaaS or something like that. So totally agree with you there. Why? So I know you mentioned that you've kind of been in all the different kind of facets on when it comes to capital stack. What attracted you specifically about attracted to early stage, and what's kind of the founding story of SWAT?
Two great questions. Maybe I'll start in reverse. So founding story of SWAT is a fun one. It's actually the brainchild of my two other partners named Mark Hauser and Rich Kirschenbaum. They come from opposite ends of the experience spectrum. So Mark has been a lifelong kind of professional investor in various companies, privately owned, entrepreneurially owned, family owned for a while. He's cut his teeth kind of helping those businesses capitalize for growth, capitalize for succession change, capitalize for different reasons, and helping that management team and those business owners really achieve next chapters of growth. But they're more mature. They're generally cash flowing. They have that fun EBITDA number that is a positive one, not a negative one like I tend to look at now in venture. But he's just been a really great investor and advisor to those businesses for a long time. He's had a close friend and still remains a close friend named Richard Kirschenbaum. Richard does not come from the investing side at all. In fact, quite the opposite. He has spent his entire career in the branding, advertising, and marketing creative world, helping companies name their brand, build a brand, rebuild a brand. What he's really good at is the instinct and gut around, does this particular company have the right assets, digitally, analog, or otherwise, to help convey really differentiation around why that particular product of that company or that service is different from another, and making sure that that messaging is getting across to the intended customer, whether it's consumer or business to business or otherwise. So the combination of those two skill sets, they thought would be interesting and could be more uniquely applied to what was at the time, and I still think is, a nascent space of investing in earlier stage consumer companies that required capital for growth. More traditionally kind of thought of as venture capital because they're young, they're growing, they aren't cash flow positive yet, but we all call it kind of really early stage growth equity investing. Our focus is seed and series A when we get technical about what stages we like to get involved. And that generally means that the business has been in the market, they've launched, their product and or service is and being consumed by a small set of initial customers, and they're looking at ways to grow, scale, and continue to build out that customer segment.
How do you think about? I appreciate you mentioning like the proposition of SWAT, which was taking Mark's background from investing and an expertise from in that world, and also Richard's expertise when it came to the brand building side and kind of having that come together to become SWAT. I also thought you said something really interesting as well about how since it's early stage in consumer, a lot of it's called venture capital, but really how you think about it, it's early kind of growth equity investing. Wow. What's the difference between venture capital and how you're seeing it in the way that you invest in consumer?
Well, I don't know if the founder community views us any differently than an early stage, what's called venture capital investor. My background is another complement, I think, to both Mark's and Richard's lenses, if you will, to how we approach sourcing and diligence. And that is a healthy mix of good old-fashioned private equity rigor that's associated to the process of how we sourced and really diligenced and structured, quite frankly, investments in bigger, more mature businesses to protect for kind of some downside risk, but also allow for plenty of upside potential. But I've spent a lot of my career now in the venture capital community as well, and figuring out the nuances there, the tools of the trade, if you will, and the ways in which we can invest. And quite frankly, learning how to get more and more comfortable taking risk on businesses that we don't have as much information as my private equity days would otherwise provide. And the knowledge that we're going to be, involved in helping these companies, playing coach a lot, listening to and building those relationships with founders to help them become more and more confident about the decisions that they're making to scale the businesses. So the difference between, what I would call a classic venture capital approach and the way we think about building and constructing our portfolio is we are a hybrid. We are not taking what I might kind of term traditional early stage venture capital and making a lot of small investments because the risk is high and the stage is early. What we also aren't doing is putting capital into 10 companies, kind of a more private equity or growth equity approach, because we're still early in the business's cycle and there's plenty of risk left. So we're kind of going for that 25-ish company approach, not 10, not 40, but something in the middle that enables us to write a bit larger check, play a little bit more on our strengths of rigor from private equity training, and build and foster with more conviction relationships in our portfolio company, help them find next funding round, help them find next leaders of those rounds, start thinking about both paths of profitability key, critical. It's not something they can leave behind until the C round or the D round. Path profitability and ways in which to think about, potential exits. And again, in our world, it's not going to be by IPO. We fully expect most of our exits are going to come in the form of either a private equity ownership stage of the business or directly into a strategic's hands.
That's really helpful. So not, as you say, like in some ways, it's kind of like this kind of hybrid, not super concentrated where you have, 10 companies. Also at the same time, it's not kind of spray and pray, even though I don't love that language, but kind of spray and pray where you have like invest maybe like 50 or 75 companies. It's the kind of this middle ground of 25 companies. How do you think about your return profile when you actually make the investment? What's like the ideal scenario?
We try to underwrite when we make our initial investment at a seed or a Series A stage company to, somewhere-ish between 10 and 20 times our original investment in that company. So we need to see a path to making 20 times our investment in that company at the initial point of entry. It's like 20 times multiple if it's seed stage.
That's helpful. That's helpful.
I mean, it puts a lot of emphasis on how much we're putting in and valuation, obviously, that we begin our investment kind of period with them, and what we think's going on in the next 5 years-ish in terms of strategic appetite and valuations.
How also do you think about, so it's invested in 25 companies, each with when you underwrite, you need to feel confident that you could get a 10 to 20x return. What do you think about the overall distribution should be? Because I'm thinking about also kind of comparing, consumer to maybe traditional venture capital, which is very kind of power law-esque type distribution curve. How do you think about the overall distribution curve when it comes to, your portfolio or what an optimal portfolio will become?
It's such a great question. It's become a fun topic of conversation too, with just, you and I and certainly others in the ecosystem of venture overall, and as well as kind of the consumer crowd of investors. So I guess I would say our thesis at SWAT Equity is that we will have a lower loss ratio of portfolio companies. So we don't expect, 10% of the portfolio to generate our overall targeted return of, call it 3 to 5 times. We expect there will be more doubles, triples, and higher across the portfolio that net us down to that kind of 3 to 5 net return multiple of invested capital. I feel that there's lower upfront cost kind of to get a consumer brand off the ground. There's a lower entry point on valuations at seed and Series A than higher tech and life science and other categories of more traditional venture capital that also require more upfront money. So that's going to push kind of valuation up as well. And they expect a much higher return and can go public and become bigger unicorn to decacorn. So we think of it as, even though it's riskier and it's venture, we believe our thesis is that a portfolio will have just a lower loss ratio, enabling us to still generate that 3 to 5 times net return number off of 25 companies. Again,
that makes a lot of sense. That makes a lot of sense. So you have kind of more companies that are kind of hitting maybe more doubles, triples, and beyond. Less companies that are actually failing or actually going to zero.
That's right.
And so it's maybe more like evenly per se distribution curve, which is also in line with what you said about how it's kind of early stage private equity, because that's much more kind of private equity world than it is like traditional venture. Because I think it's interesting because I feel like sometimes consumer venture capital maybe shouldn't be called venture capital because for these reasons, because I think that if you're trying to build a traditional in kind of the traditional mythology of what venture capital is, then it's easy to say, oh, well, don't invest in consumer brands. That will never work. And it probably won't work because you say like the exits tend to not be, IPOs.
Right.
They tend not to be these, magnificent, billion dollar exits. But that doesn't mean you can't build an incredible portfolio and do extremely well investing in consumer. It's just a different type of beast. So
it is. And it's a different type of business than what it takes to successfully scale a SaaS company. Indeed. I mean, we're sitting around the table talking about channels of distribution, metrics therein, and how you grow revenue with a fast-moving kind of consumer packaged good that has low barriers to entry to get the business up and running. You have a co-manufacturer. You can start with an e-commerce channel. You can do your own marketing on social channels. It's very much a different business model than figuring out what the cost is of getting the minimum viable kind of product up and running with engineering talent in a software solution world, and then the process of going through the sales cycle of finding the initial adopters, the second level adopters, and how long that takes, how big. Now, those are great businesses too, and they're in fact probably stickier and just carry different valuations. But we can generally get into a business in terms of the valuation entry point for us that's between like $10 and $20 million. So for us to see 10 times, return on that investment in the company, if you do the math, it's kind of a $100 to $250 million sized exit valuation, which is completely reasonable in our world.
Yeah, no, that's a great point. And also, at the same time, when you're investing at the seed series A, there's a lot more data as well. These are products that are, I'm sure post-launch.
That's right.
For sure, unless it's, maybe very specific like food tech or, there is like a lot of IP that's associated with the actual product itself. But for, high growth brands, kind of in that lane, definitely, post-launch, so you have a lot more data to kind of collect and think about. I know one of the things you said as well that was interesting too is that when you invest, there has to be a clear path to profitability. When you're diligencing a company and you're evaluating companies, how do you think about this question if there's a path to profitability, and maybe what are some of the mistakes that you maybe see entrepreneurs might do that you're talking to at your stage that maybe might not lead to profitability long term?
Ooh, there's a lot in there to unpack because it's such a great question. Path to profitability. We don't expect at the stage at which we invest company to be profitable on the EBITDA or kind of below contribution margin, below gross margin line, below kind of all the G&A. They're at that point in their little beginnings of life cycle here where they're investing ahead of profitability for growth. But that path to at what revenue level do we want to hit where we know we could be break even to start being profitable, so that basically we have more options available to us than relying on the kind of venture capital community, which is looking for a lot of growth to drive increased valuations on the next round of capital. It can get into a pretty tight spot and tough situation to begin if for whatever reason growth slows for some very good reasons and maybe not some good reasons. So when we kind of look at our diligence process, we think about not just kind of the overall market opportunity in the form of TAM. We are actually digging into what are the unit economics on this product, for example. What are the retailer channel economics? So what is it going to cost the company to launch on Amazon? What might it cost the company to launch in wholesale in the conventional grocery channel? And then we'll look at particular account profitability too. Because if those numbers are too low to begin with, as well as I, that it's hard to kind of pull yourself back out of a low margin product line, account, channel, etc. It takes time. So if they're not starting from a pretty strong place of unit economics, account profitability, they don't have a long hope. It's just not a sustainable kind of position to be in to keep scaling. So mistakes that I see made kind of often are a rush to open a channel, open an account within that channel that doesn't have the proper support kind of factored in, modeled in, kind of contracted in with a particular retailer, for example, with respect to how often you have to promote, how often you have to provide kind of couponing support, how often you're contributing to an ad spend bucket of the overall retailer. I mean, there are a lot of little nicks at the profitability kind of chip that come along the way, and they can add up. And for a small brand with no leverage, that becomes challenging to withstand. And then you get into the, situation of it's not working, so we're going to exit that account. And optically, that can be difficult for the brand as they kind of continue to build relationships with other retailers. So we want to help educate, to help think through all of those decisions by just applying some learnings that we've developed over the course of our kind of careers, as well as portfolio building, to the founders in our portfolio as they're taking on these decisions. We recognize we don't have control over those decisions. As a venture capital investor, that's the other learning I've had to transition through is I don't have economic control. So all I can do is build a good relationship, based on trust and integrity with these founders to make sure they know they are welcome to call to gather input from me. I'm going to provide some suggestions. I want to be involved in understanding some of that detail, but I'm not making the final decision. They just need to keep pushing on getting to the right answer as they start opening up more of accounts and more of these channels. But if you don't kind of have an eye toward profitability, in the longer run, and set your sights on, can I be a $20 million sized revenue business in e-com, Amazon, and a channel of brick and mortar retail and be break even? And I'm kind of picking 20. I don't know if that's the right answer for any particular, company in a different category within consumer. But if they don't apply their vision for the business with this lens, it's not the only one, but with this lens in mind, they're going to be on that tough treadmill of constantly dripping capital into the business in order to find profitability. And it's just not a long-term sustainable answer. And they'll have fewer and fewer options available to them as they continue to grow. It's a long-winded answer, but there's so much going on.
No, I appreciate it. And we've heard, I just came out of I did a panel in Austin last week.
Looked like it was sold out
with 3 funders. Yeah. It was a lot of fun. But one of the funders said that there has been a kind of a shift towards VCs, that there's been early growth equity investors. That a focus from, how much does it cost to kind of acquire a customer versus versus the actual retention on those customers, and looking through those cohorts, because then if you're able to retain and focus on retention, then can you build, as you say, like a $20 million break-even business where you don't have to continuously focus on acquiring more and more customers per se. No, that makes a lot of sense. How do you also analyze certain categories that you might be interested in? And do you ever get the feel if there's one that you think is maybe too niche-y, that is going to stay niche-y, or maybe are there early signs that one could be break out into be more conventional and mass market? Or kind of how do you think about kind of these things when an entrepreneur approaches you with their business?
Another great question. And this is one of I think our biggest challenges investing in this category is because the barriers to entry are low, there's so much noise. And so for us, time is your most precious resource. Figuring out how best to filter our funnel of opportunity is a constant evolution of thinking. There are plenty of like basic tenets that apply, but we are following consumer trends, and those trends move at different paces. And so we aren't so specialized that we focus only on one category. We do like to have that kind of diversification in our portfolio across a variety of consumer categories. So we have to look at a variety of those consumer categories. I think the two things that we use to filter on most have nothing to do with quantitative metrics, actually. I mean, yes, we like to see something that has $1 million of revenue or more because we want some initial traction. But there are two things I think that we use as an overall filter. One of them is the customer this particular brand is targeting, how underserved are they? So where is their friction point that this particular product or service is offering to solve, and how much of a pain point is that? How underserved are they? And I can talk about a couple of examples, but that's one like large swath of filtering. An example would be Womaness, a relatively recent addition to our portfolio. It's in the beauty and wellness categories, but they are products designed and marketed to women going through peri and menopause symptoms. So they are likely more Gen X right now in age profile. But what we loved about their approach that Sally and Michelle, the founders of Womaness, are taking is they're developing a brand umbrella to the various products, skincare, supplements, and feminine kind of care that can be embraced, quite frankly, with positivity. In fact, that's one of their taglines is menopositivity around this hugely stigmatized kind of period in a woman's life. So we just felt the market opportunity is massive with so many kind of women going through this phase in their life around the world. And there's no one brand that kind of speaks to with one brand kind of message, all of the types of products that could be used here. So we felt that she was pretty underserved, and therefore will look for kind of today more solutions to their problem. And then her millennial sisters are certainly going to be asking for a more specific kind of design for them approach to this kind of age challenge. Another example is Mad Rabbit. It's another kind of skincare brand, but their underserved customer focuses people with tattoos. And so as you make this investment, and some of it's significant in putting art that you are very passionate about on your body in the form of ink, how do you then take care of that tattoo? And what that team has developed is kind of a tattoo safe formulation of skincare products that help protect, preserve, and kind of make that tattoo feel more resilient and brilliant over the kind of course of life than if you didn't do anything. And 46% of US adults, we believe, have one or more tattoos. So it's a big audience that's still not really been spoken to. They've been underserved in terms of like products that are available to them for their specific wants and needs. So that's a big way in which we filter. The second one I mentioned is differentiation. And again, in a world of low barriers to entry in developing and launching a consumer brand of product, particularly, what is this team doing? It relates to kind of how this underserved customers' needs are getting met, but how are they conveying the messaging? How well is the branding kind of structured to catch the eye, literally and figuratively? It doesn't need to be perfect when we make our investment, but we do, because of our kind of background and expertise in branding and marketing, have a lens of strength there that we can really dig into. How well do we think their messaging? Is there room for improvement? Do they want to improve? And are they really differentiated in their kind of product or service offering than there are many things that could be on the shelf that the customer is looking at.
I really appreciate this kind of in depth that you brought to the table with Mad Rabbit and also Womanness. That's amazing. And also
self-serving certainly on my portfolio's perspective, but
no, it's great. It's great. And also I think about differentiation. I think you also brought up a really good point in that with consumer brands, it's really hard to break through the noise because there really isn't as much, kind of upfront cost. On the distribution side, right? Maybe they have a very differentiated product. Maybe they are serving an underserved customer. But how do you know if it's actually working and actually the company's actually able to kind of break through the noise? Or is there kind of a couple metrics that maybe stick out that you like to look at, or it could be, feedback or what have you? We'd just love to kind of hear it.
We don't have a fully baked kind of formula, but drawing comparisons across the portfolio is one way we kind of hit it. When a brand we invest in has a substantial channel of e-commerce revenue in terms of revenue streams, one of the ways we try to evaluate that is through retention, returning customer purchase rate. Doesn't just have to be about subscription, because that's one marketing tactic in my mind of generating revenue that's stickier, and not necessarily, the long-term answer, because not everything that you buy needs to be on a subscription. It's subscribe and save. I mean, it's just kind of it's a promotional kind of stunt in some cases. But looking at, depending on category, how customers are returning to the e-commerce site to buy more product is one way. We look at a lot of reviews, and we look at them across as many channels as we can get access to. Obviously, their own e-commerce site, their Amazon site, going to other kind of customer review platforms to see is another way we think about it. It gets harder, obviously, as you get more omni-channel and you start building out distribution in brick and mortar. There you don't get traffic count, and you don't get that Sarah went back to Ulta to buy more Womanness product, 3 weeks after buying her first one. So attribution in some ways around what do you do to play off the shelf space and kind of bring people online is an area of discovery that we kind of like to go through, but don't have a minimum kind of hurdle set for what you have to, what a company needs to be doing.
No, that's helpful. And I think it's also interesting to hear how you think about the kind of relationship between online sales and also sales, in person, where, brick and mortar, a wholesale business, it's really hard to know what types of customers you have a genuine idea dependent on which retail channels that you're going through. But at the same time, you don't have, a lot more information that you can gather from going online. How do you think overall, if a company is expanding from their e-commerce business, they maybe have a very strong e-commerce business, to retail, how should they think about that overall process of going omni-channel?
Well, I think it's critical in most cases, because I do still believe that the consumer is purchasing products 80% of the time in a brick and mortar type of retailer, right? So you have to have a presence in some fashion in some wholesale type of channel, and that type of channel is going to be dependent on what type of product and category you're in. But it serves two purposes. Obviously, it's a sales revenue generator, but it's also brand awareness, and that accounts. There's an attribution to brand awareness either, but having more people find and discover you, and then move to their preferred channel of consumption is really important. But just the numbers tell you've got to have some presence outside of digital in order to really scale a brand. More importantly, demonstrate to the next owner of said brand that you have real brand equity, which is what we're playing for, right? At the end of the day, it's that intangible on the balance sheet that continues to grow and grow and grow as the brand becomes more and more visible, viable, etc. So, but that's all easily said. and you're an operator, founder, kind of running a business, and it's overwhelming to just manage your e-commerce and then maybe start to manage an Amazon channel, which I believe is key and almost table stakes now. How do you crack into brick and mortar? I think 3 years ago, I probably would have answered a little differently than I would today, given the kind of supply chain distribution difficulties and challenges the pandemic has presented a lot of our favorite retailers. They're still going through it, and it's still not over. But I wouldn't recommend each brand knock on the biggest retailer in that channel, call it mass or drug or grocery, and say, please take my product. You have no leverage. You won't get any support. You get one shot for the most part at putting product on a shelf and hoping that you get the velocities they expect, or at least you start and you want to exceed them, right? To stay on the shelf and gain more shelf space. That is the game. So what we talk to our portfolio about now, those that are in the process of starting to think through their brick and mortar retail strategy, is come up with another innovative kind of creative solution to testing. Don't go with the A quality kind of retailer accounts. Think maybe more regionally. If you've got concentration of customers that you can see online that are in the South or in the Southwest or in the Pacific Northwest, find a good regional partner. Figure out what the channel that's appropriate, grocery, drug, beauty, specialty, whatever it may be, and approach them, because they're likely not approached that often. They will hopefully pay more attention to you, and you can start testing in a way that doesn't require you to build the inventory, the team internal kind of resources and marketing dollars to support a launch in Target, to just use Target as an example, across thousands of doors, hundreds to thousands of doors. That's a massive investment and commitment, and you don't know if it will work. It takes time. It takes time to kind of build great relationships with these big retailers that are moving a lot of volume. So I think at the moment I would rely less on that playbook and flip a new page and come up with a different strategy that can differentiate you.
So go an inch wide, a foot deep, instead of going a foot wide and maybe an inch deep per se.
Yeah, maybe, but be strategic about it and understand where your customers today shopping, where they're located, and for example, Stix in our portfolio is a great women's health brand that's got great products that you would normally kind of find in the drugstore, but they have a pretty big presence with college-aged consumers. So is there a different idea there to go figure out what that distributor is doing on college campuses to populate that store and give access to all, more students who are going to be bigger consumers of their product, instead of just asking CVS, can we go into 4,500 of your doors?
Yeah, no, I mean, that's a great example. Just in terms of what you actually could be doing, and I also just appreciate that of focus on the actual regional side rather than trying to maybe try to go national throughout the gate, and focus on testing and seeing what how to actually increase velocities regionally, and actually what's working versus what's not working before you maybe go out and do a national campaign. So that's really helpful. I know, what is, after you make an investment, and I know that, you kind of have a wide range in terms of, and maybe you'll say it depends, depending on the company. But as you say, maybe the goal, which is, a very strong return, is maybe having an exit of maybe $250 million, for example, or somewhere in that ballpark. It's not, going to be an IPO, or going to be maybe $1 billion transaction. When a company takes money from SWAT, is the goal that they fundraise again, and that, or is it, or and they kind of keep having venture capital dollars, private equity dollars, kind of in part of their capital stack, or is the goal that this might be actually like the last time that you're actually going to fundraise from us? Like, how do you think about that in terms of and how founders maybe should be thinking about their cap table if they are a consumer brand?
So I remember our initial investment is typically happening at that seed or Series A stage. So it's on the earlier side. No is the answer on, do I think we're the last capital in? Definitely not. I fully expect them to raise 2 to 3 more rounds before more options are kind of available to the company in the form of less VC minded, I would say, investors, more, call it mature thinking, meaning the business has matured, they're profitable, they may be more appealing to a growth equity or even private equity kind of return profile investor, if not the strategic. That's why this path to profitability conversation is so critical, because once you have profitability at the business, more options open up in terms of financing for you, including non-dilutive capital in the form of debt. Now, I don't recommend just taking only debt on, because it comes with some hooks as well, as it should, but it's non-dilutive, and that's not unimportant to a company founders that have raised kind of a few rounds of capital, and they want to make sure they still are in a good ownership position. So the answer is definitely no. We fully expect these businesses to raise some additional capital in the beginning to afford the burn rate. So they're still loss making, but there's a second step of we've reached profitability, but we know the following 3 things really work in terms of marketing tactics. And we want to raise $15 or $20 million to really apply judiciously, but kind of supercharge growth, which might look like we go negative. We start to lose money for a short period of time, but we'll catch back up and become profitable, within, a year, but not remain unprofitable. That we see happening with a portion of the portfolio too.
That's also really helpful. How are you thinking about as well, kind of the current state of the market when it comes to investing, and maybe some of the changes compared to 2021? I know we've heard a lot on the tech side. It's kind of well reported, but would love to kind of hear it too on the consumer brand side, how you think about valuations, multiples, and as well as like where you kind of see, is it more of like an investor's market or an entrepreneur's market?
Well, I think it's swung to more investor friendly for the marginal dollar. There will always be that cream of the crop group of businesses, brands, companies that have great metrics, great traction, great performance, raising capital for one of the couple of reasons we've talked about. Perhaps it's funding new launch in a couple of new retailers, and they want to be sure they have the right kind of cash mix on the balance sheet for the inventory build and working capital investment, or it's these incremental kind of marketing moves that they want to make and invest a little bit ahead of the revenue attributable from them. They will continue to raise rounds at pretty good valuations. 2021, I feel, was peak as far as we've known it in the last 5 years. I would say the consumer category is kind of still experiencing valuation disruption. We're not, I think, all the way through it because these companies that raised in the last 12 to 18 months are coming back to market still now and starting to experience what the new world order feels like. Valuations are generally down. Are they down 25, 50, something more percent? They're certainly not down as far as the tech sector, I believe, has fallen from what we understand in the public markets, and maybe some more in the private markets with more kind of funds starting to report as we get into second quarter and third quarter. But I also feel our tail on consumer and their performance, meaning the consumption habits, is less known right now because of the broader economic slowdown, the big feared R word coming around what our spending habits going to look like next year. The consumer's balance sheet has been pretty healthy this year. Yes, a portion driven partly by this kind of supplemental capital and things that the government was using during the heights of the pandemic. And thankfully, consumers saved a lot of that and is now spending it. I mean, you look at anything in the hospitality industry, from airlines to hotels to restaurants, those prices are crazy up. I've never seen them like that in my life. And I've lived through a couple of these cycles. I don't know when they'll come down because the demand is far outstripping the supply. But if you're going shopping and you see the inflation on a carton of eggs, milk, other kind of wheat-based kind of commodities, prices are up, and people will start, likely substituting some brands for some private label or going next brand kind of premium down. So I think the lag that consumer is going to experience is a function of, we don't know exactly how they are going to respond in their ultimate consumption habits over the next 12 to 14 months. And that's what's causing consternation, I think, in the investment community.
Yeah, no, those are excellent points about what's kind of currently happening in today's market. When you think about prices and inflation, and also just, hospitality, it's pretty unbelievable. Some of the
and luxury, real kind of high-end luxury will still be very, very fine. It's a tiny part of the market, even though it's a lot of dollars that are funneled that way. But, we've got this strange or more unique intersection of raising prices associated with inflation and higher interest rates. And so that convergence, I think, is going to cause a different type of feeling recession maybe, or economic slowdown than we've had in the past few. Whether it was 2008, 2009 with the global financial crisis, or earlier in the kind of 2000s with the former .com kind of bust. So we'll see. We'll see what happens. But I also think it's a great time to build it's a great time to be an investor for the next 12 to 18 months. And clearly that's where my bias lies. And I'm going to be anxious to keep investing in more companies because we have a long-term view, Right. We're looking at companies that will exit in 5 to 7 years. That's not going to be in the middle of an economic slowdown. So we're mindful of that and really want to build another strong portfolio.
Yeah, no, that makes a lot of sense. Now it's a great time to actually enter companies because, as you say, if the R word is coming, it's not going to last forever.
Right.
Agreed. And so, how do you also? Are there any types of trends trends? Are you in consumer that you might actually be bearish on, or maybe it's a bit too, niche-y that maybe you will not, kind of be reach kind of like the a large enough group, a large enough audience where it actually doesn't make sense for you to actually invest?
It's a good question. One that we've been struggling with internally is what's going on in the alcohol industry, meaning the low alc. I don't have an issue with it all. The non-alcoholic category is a question for me. Now, I'm not the target demographic for those products, really. I'm too old, and I enjoy my spirits in obviously moderation. But I'm all for healthier ways to take the edge off, if you will. I just don't know how much I feel the fear of missing out factor on wanting to take part in celebrations where alcohol may be served and you don't want it for a variety of reasons, all personal, and you choose to have a non-alcoholic wine or a non-alcoholic cocktail versus something that can maybe take the edge off, but in a healthier way because it's more of a functional ingredient. So maybe it's an adaptogen or something that's in a ready-to-drink type of product. I don't know. I feel like the jury's out. I do feel it's a bit more of a fad at the moment, but I felt somewhat similar about cold brew coffee in the beginning in like 2016. And it's proven to be a trend, not a fad. It will never catch up to the size of the overall hot kind of coffee category at all. But does that mean that the brands who want to continue capturing the next generation of consumer and have a product offering for them will pay attention to it? Yes. And I do feel the same about, I think, the spirit and overall alcohol industry. Those large conglomerates can't leave can't leave maybe a growing category of consumer behind. I just don't know ultimately how big this category may end up representing. So we've chosen not to pursue it quite yet. Again, what we've spent more time looking at are the more functional ingredient types of beverages that can produce a similar effect, but it's a healthier it's likely a healthier outcome.
I appreciate you walking us through how you got to, if the goal is to like take the edge off, how can we take the edge off kind of in a healthier way, as opposed to not actually, there's kind of no, you actually aren't taking the edge off with like non-alc. There's no, it's not actually changing your body in any kind of way. So I really appreciate you kind of walking us through why you might be unsure about non-alcoholic at this point in time, and if it will stay kind of a niche, and people still maybe want like the taste of alcohol but don't want the effects, versus something else. So that's really useful. I
put it kind of in the category. We think about the brands that we invest in as either, and this isn't news, this isn't profound, but they are either category disruptors. So I think about that as like Banza. Our pasta business is a better for you pasta. Pasta categories, everybody knows what it is, everybody knows how it works, etc. It's just a different ingredient formulation to it. So they don't have to do the work to educate the consumer about what their product does. They just have to take share from the big existing ones, the legacy brands. Versus something in that non-alcoholic space is much more of a category creator. So is cold brew. It was educating the consumer about what exactly it is, and here's the product. And we need, you need almost two levels of marketing support to kind of achieve the same goal, to achieve the goal of scaling, which can be harder, but most of the time you do it because the payoff is greater. That you're creating something that's more unique, and therefore because it's scarce in kind of supply, both the consumer as well as the ultimate acquirer of that company, that brand, will want it more, and therefore you'll pay more for it. But that's what I think about with non-alc, and we've got examples of that in our portfolio too. Womanist is another one. It's trying to create this generation of Gen X women about destigmatizing menopause, and finding products that she'll want to use that are effective and help her kind of manage through some of those symptoms.
No, that's great. I mean, it's really, I also like these kind of two-layer of marketing, how it's an opportunity if you can nail it, but at the same time, it's a lot harder to actually communicate that though with consumers or people. So there's also kind of a barrier there as well.
Yeah, there is. I think you've got to be cognizant of it, and you've got to factor it into your capital needs. There's going to be a bit more marketing required. Right.
That's a great point. My final question to you: what's one book that's inspired you personally, and one book that's inspired you professionally?
I just finished on Amazon. Let me just get the title of it. It's by a favorite author. No, this is a personal one. It is, I think it's called, Carrie Soto is Back by Taylor Jenkins Reid. And it's a fun story about a woman who was a #1 tennis player in the world and then retired. And she came back out of retirement to pursue just 4 Grand Slam tournaments to try to win one. There's a lot of kind of fun analogies around actual historical figures, I think, in tennis, men and women, that the author kind of alludes to. But I just thought the whole storyline and the character development was a lot of fun to read. Professionally, I love what I do, believe it or not, so much that when I take the time to kind of read up on things that are in my professional life, I often turn more to kind of newsletters than I necessarily do to kind of books on how to lead or those topics they're also important. But I find I get more out of like Forerunner's newsletter than going to a book to figure out kind of consumption behavior. So that's what I would say. Professionally, I love reading some of my great other consumer investors' newsletters to get a thread on how they're thinking and what's fascinating them at the moment. And then for fun and kicks, I go way down into kind of the fiction zone, and I like thrillers, suspense novels, and then that particular book I just finished was really good.
That's awesome. That's great. It's great. Yeah. Also love newsletters. And this is, no one's ever mentioned Carrie Soto is Back, so we are excited to add that to the news.
You can start a book club, Mike, and you can have that as another major use of your time, which you don't have.
Exactly. No, it'd be great. Well, Sarah, this has been so much fun. Thank you so much for your time.
A pleasure, Mike. As I said before, I've been looking forward to doing this, and I truly admire and respect what you've been building. So I'm happy that I could play a little role.
Oh, please. I'm so thrilled that we finally got to do this. I know this has been, we've been chatting about it for such a long time.
I know, too long.
So thank you again. And there you have it. It was such a pleasure chatting with you, Sarah. I hope you all enjoyed it. If you enjoyed this episode, I'd love it if you'd write a review on the Apple Podcasts. You're also welcome to follow me, your host, Mike, on Twitter @MikeGelb, and also follow for episode announcements @ConsumerVC. Thanks for listening, everyone.